one man can make all the difference. And today we're going to see the inspiring story of the father of index investing. Fund houses must provide them a way in which they can invest their monies on a low-cost model. And thus came the principle of index investing in the US. But let's first go back, rewind to the life of John Bogle. Many a times we ponder in our life whether one man can make a difference. But it is true, one man can make all the difference. And today we're going to see the inspiring story of the father of index investing. Yes, I am referring to the one and only John Bogle. John Bogle believed fundamentally that investors need to invest, not speculate. Look at long term, not short term. And fund houses must provide them a way in which they can invest their monies on a low cost model. And thus came the principle of index investing in the US. But let's first go back, rewind to the life of John Bogle. John Bogle was born in New Jersey in the year 1929, in the heart of Great Depression. In spite of all what he went through or his family went through, he graduated from Princeton with economics and investment as a major and topped it. Then got into an investment fund called Wellington Fund and worked his way from the ranks to rise up to being the CEO of Wellington Fund in 1970. In 1974, very bad investment decision to merge another fund with it found John Bogle out of job. He was thrown out for a bad investment decision regarding a merger of his company. And he had the honesty to admit later that it was a very, very poor investment call that he had made. But he said there is always a learning from anything that we do. That is that there is a learning, and then if you can correct it and move on, the prize will be much bigger later. And that's the man John Bogle was. He didn't let the failure or the expulsion from his company lead him down. He moved on and started out the next year. In 1975, he launched the Vanguard Group. In the Vanguard Group, his fundamental principles were, as I said earlier, to provide investor as the center of the universe. How can fund houses provide investors the experience? Second, he said, lower the cost of fund management. And the way to do that was to replicate the index. So S&P 500 was the index they chose, and they tried and replicate. By replicating, you didn't need a fund manager, you just needed to follow the index. Therefore, cost was brought down significantly on that grounds. And third and most foremost is that index investing, if held for reasonably long periods of time, gave you stupendous returns as well. So that's the principle he applied. And today, globally, index investing from those modest beginnings in early 70s is now $11 trillion industry. In fact, United States, which is the mecca of mutual funds, has more index funds than active managed funds today as we speak. So the size of the index fund investing has really grown in size and shape over the years. And all the credit for that goes to the one and only John Bogle. In fact, John Bogle, when he launched his first index fund in the year 1975, was actually ridiculed because the belief at that time and even now is that active fund management must beat index. And people asked him, why would anybody come and invest in index? Because they want to beat the index, right? That's really the idea. And Bogle said, as long as you get good index returns held over a long period of time at low cost, it will still be a very, very good product for investors. And lo and behold, after almost 50 years, he is bang on right. The history of index funds in India is just catching on. We are just at the cusp of the journey of starting index funds. In fact, if you look at the history of the last 10 years performance over some of the active managed large cap funds with the Sensex index plan, it shows that the active managers have still continued to beat index in India. But the day is not far when index funds in India will also be on par as they are in the US. Their size is growing slowly but steadily. I seriously urge you to consider an investment in index funds. Do think of John Bogle and say a silent salute to him, and he is the man who made it happen. Now up for the case study. For a corporate client where we had been doing treasury for a long time. This was a corporate, it was an IT company where we were kind of giving them products for their treasury operations, placing it in liquid funds, short-term debt funds kind of products constantly and kind of helping them run their day-to-day operations. We found that over a period of time, a small amount of that money was always lying in the account. So we spoke to the owner of the company, the managing director, and had a chat and asked him whether he would be interested in moving that small portion into some equity fund. Being a very risk-averse person, the person didn't want to kind of expose company money to any equity stock market kind of stuff. He only agreed on the condition that it was index linked and it was for a minimum period of 5 years. So on that condition, we have exposed that small investment. Why I use the word small is because the bulk of the money is treasury related. We have only taken 5% of that quantum into index funds. Large cap Nifty 50 index fund is what we have chosen for them. And they used to do a recurring deposit, an RD in some sense. And we have asked them to kind of divert a part of that RD into an SIP into the same fund so that it can build a corpus. Our view is that as compared to that 5.5 or 6% they would likely to make in RD and liquid funds, in these kind of a product, because a certain sum of money constantly lies in liquid fund, they can generate a much higher return. Maybe a 10% return or a 12%, although it is not guaranteed. Our belief is if this is done over a 5 to 10 year period, they can make substantially better returns than being only in liquid and treasury. Mind you, my purpose in this is not to kind of divert corporate money into investing purposes. The idea is to achieve a much higher weighted average return on the portfolio. And one of the ways to do that is if part of the money can be exposed to equity and low volatility equity like an index funds. That's really the idea. I thought we should talk about this case study as well, and all thanks to the magic of John Bogle.